It is that time of year, folks. It is tax season. And yes, which is that IRS deadline where you need to have those taxes paid and filed. You are going to have to be dealing with those tax documents. You are most likely have received some 1099s in the mail, some W-2s, those type of documents that tell you how much money you've made, and also to let you know how much you're going to be taxed or how much you've already been taxed in many cases. So this is going to be that process where you can look at finding a way to one, lower that tax bill, but also do some financial planning for the future and some tax planning for the future, which is super valuable for you. So I really wanted to kick it off with letting you know that, hey, if you're not on it and you haven't been paying attention to those documents, go back, look at that mail pile, start looking through those documents. A lot of these things are digitized now. So if you work at an employer, that tax document that you've been looking for, maybe you haven't seen it in the mail yet, it just may be online. And a lot of companies are switching to having that access available to you online electronically so they can save some money and you can get that tax form a lot quicker. So be on the lookout for that. That is, you need to go to someone that's qualified to do this work. And you need to take your taxes seriously. I think the mindset of what people have been doing previously to get their taxes done has actually not been a beneficial thing for the community because one of the things that people think about is getting a refund. And there's nothing wrong with that of getting a refund, but how can I maximize my refund? But if I know someone that knows someone that could hook me up and getting me a bigger refund, then I'm going to do what that person is suggesting I do, or I'm going to have them do my taxes for me. But before you jump into through all of those hoops and just say, hey, this person is going to give me $2,000, $5,000, $10,000 back, are they a legitimate person? Are they qualified? Because there's a lot of mistrust from a financial advisor standpoint to people that are promising people refunds of a certain dollar amount. That's not going to be something that I'm going to sign off on for my client to say, hey, if someone's going to guarantee you a certain amount of refund and they haven't even looked at your taxes, they don't even know your income situation, they don't even know your lifestyle situation, that's a red flag. You should not be engaging with those type of people. Most likely they are not qualified to be providing that type of information. Now, can people help you find deductions, tax credits, things of that nature that could help you with your saving you some money, helping you get a refund, lowering your tax bill? Uh, yes, though they can certainly give you the ideas and to bring up things, but you want to file this stuff legally. You want to do this because if you try to fudge those numbers and maybe you're like, hey, I don't make that much money, the IRS is never going to come looking for me. You'll you really come to a point where it limits you on doing other things in the future for yourself. So if you want to apply for that business loan, if you want to apply for something with the government, maybe it's some type of government assistance, not for business, just but for yourself in your later years. But now you're kind of worried about what you're filing because it's different from what you were filing in the past, which probably wasn't true, and you don't want that discrepancy to be flagged. So you're putting yourself in a cycle of not getting the opportunities that you should be getting because you're filing your taxes incorrectly and you're fudging the numbers. So it's limiting your bigger opportunities. This is something that I've seen also going on with student loans, where student loans are actually being forgiven for people. And actually, you can actually go to the website and use your IRS data to help you actually qualify for a lower student loan payment. But people are concerned about them pulling their tax information. You've already sent this information to the government. So repurposing that information and sending it to a different department rather than just the IRS, you're sending it to the Department of Education so they can qualify you for the appropriate program. So you could potentially qualify for public loan service forgiveness, which would eliminate some of your debt, or the uh, IDR, which is the income deferment repayment program. You could potentially save dramatically there. So, but you have to be able to uh, file your taxes correctly, Do it with people that's trusted, so you can utilize all the benefits that are available to you. And you will not be able to do that if you're fudging the numbers, because you're going to lack trust in the system, because maybe you have done something inappropriately, or just a mistake, and mistakes can be corrected. So if it's just a mistake, those things can be corrected. That shouldn't be something that limits you from actually taking advantage of all of the different, and some people call them tax loopholes, but they're literally, it's tax law. We call them tax loopholes, but they're laws. These are laws. People, long as people are coloring within the lines, doing what they're supposed to do, it is okay for you to take advantage of the tax benefits for yourself, for your family. So we'll get into those, but I think one of the biggest things I can emphasize for you is to go to trusted professionals. So when you know you're filing something with the IRS, Department of Education, or for a small business loan, or any other institution, you know that information is accurate and it is done with the utmost trust that, hey, everything's going to come back checked, verified, good to go, and you can move about your whether it's your business or your life with a lot more ease, a lot less stress, and things can run a lot smoother for you. So make sure that is done. The one last thing on student loans while I'm on the topic. Yes, if you had student loans or you know someone's student loans that was forgiven this year, I literally know quite a few clients and non-clients that had student loans forgiven. These people may be concerned, well, hey, I had $30,000, $50,000, $100,000 worth of student loans forgiven. Will that count as income? Because that is the fear for some people. Well, the answer is unfortunately it depends. But in the state of Tennessee, we don't have a state income tax. And on the federal level, it has been announced that right now that if you have a student loan forgiveness from the federal level, that income, you'll still receive your tax documents. You'll still need to report that information, but that is not going to count as income for you for that forgiveness amount to be taxed. Now, on the state level, depending on the state, you may be subject to taxes from the state level, which is a lot lower than the federal tax brackets, but you still may have a portion of your money that is taxed. So keep those things in mind. Just depending on the situation, depending on the state, that may be the situation for that family member. So I wanted to give that little nugget out there as far as tax information as well. So if you are in that situation, please do the research, look up and see if your state actually does state taxes. Uh, and if they do, there is a chance that they are going to tax any student loan forgiveness. We're going to kind of transition now into some of the things that you can do on a tax planning side. And one of the things I always go to is the 401k plans or your workplace retirement plan. All companies don't have a 401k. Maybe it's a 403b. Maybe it's called a 457, but all of these are employer-based retirement plans. It may be called a SEP IRA for you small business owners, or if you are working at a smaller business, and maybe it's called a simple IRA. There's still an employer-based retirement plan that you can put money into to help one save on taxes, but also to save for retirement. This is one of those incentives. The tax system is set up for you to incentivize you to do certain things, and they reward you by providing either tax deductions, tax credits to help you when you file your taxes, so that, hey, if you're going to be helping the public good, if you're going to be helping the overall economy, if you're going to be doing some type of business, these are things that the IRS is going to have in their tax system that show some type of benefit. Now, it may have some limits to it, but there's going to be some opportunity there. And one of those things is the 401k. We talk about the 401k because many employers also offer a match. The employer gets a deduction in many cases, and also you get a deduction if you put money in what's called a traditional retirement account. In a traditional retirement account, whether it's a traditional IRA, whether it's a traditional 401k, we call that money that goes into that account pre-tax. The reason being is because it provides you a deduction immediately on your income. So if you make $100,000 a year and you put $8,000 into your 401k. When you receive your W-2, it's going to show $92,000 as the income that's reportable for taxes and not $100,000. So you're getting taxed on less money. That $8,000 is not going to be taxed at this time because it's going into that 401k and actually growing into that investment account. So that is a benefit where as long as the money is in that account, it's protected. As long as that money is growing in that account, it's still not going to be taxed. It doesn't get taxed until you take the money out, which may be in retirement. Maybe it's before then, but if you take it out before retirement, which the IRS qualifies as 59 and a half, they're going to they're going to tack on a early withdrawal penalty unless there is an exception to the rule, like a unforeseen emergency situation, like a disability, maybe there was a death of your spouse or something of that nature, then or some type of hardship, then maybe then you can get around that rule there. But the main point I want you to know is by putting money in your pre-tax account, you save money now. There's other retirement accounts called Roth accounts, whether this is a Roth 401k, a Roth 403b, etc. These accounts are after tax accounts. These accounts do not provide a tax deduction up front. Some people are under the perception that you're going to get a tax deduction for putting money in a Roth account up front. No, you're not. But in the future, in your retirement years, you really can benefit from a Roth IRA. The reason for that is, yes, the money is taxed when the money goes in, but the money is tax free and comes out when it comes out in retirement if you follow the rules for the employer and also for the Roth contribution rules and the Roth distribution rules. So they want that money to be seasoned in that account for 5 years. And there's a little, and it's 5 years, but it's 5 tax years, and that's a little different from 5 years from the date it goes in. So if you want to learn more about that, reach out to me and I can go more in depth with that. But 5 years there, and you need to be over the age of 59 and a half. So if you have some money that you want to save for the future, and your company is going to incentivize you for saving that money as well. So the employer is going to get a deduction potentially. You're going to get a deduction later. You put money into this account. That money is going to grow without being taxed. As long as the money is in the account, it's not going to be taxed on any gains. None of the gains on that money is not going to be taxed. But when you take it out in retirement, you're over 59 and a half. Say you're 62 years old, 63, 65, 70, whatever the case may be at that point, and you've had that money in that account for over 5 years, guess what? That money is going to be tax-free that you pull out, and you are going to be able to take the gains tax-free, and you will have already paid the money on the taxes for the amount that you earned. So that money could go from $10,000 that you put in to, let's say, $20,000, $30,000, and that may be a contribution that you put in throughout your paycheck for just that year, because you can put into a 401k, a 401(b), you can put up amounts more than what you could put into an IRA. And I'll clarify that for you. And I try to limit giving numbers in a in this type of situation, but I think it calls for it here for you to understand and know the difference here. So when we talk about putting money into a retirement account, you can put money into a 401k, and that deferral limit is actually in 2023. So this past year was $22,500. That's a $22,500 deduction that's available for everybody, no matter the income level, that people are missing out on. And this is one of those things that people miss out because they think, hey, I don't make that much. I want to keep some of that money. Absolutely, you can, but we want to show you that, hey, this is available to you. To reiterate, go back, 401k, the amount for 2023 was $22,500. Now, if you're over 50, you could actually put in a catch-up contribution of up to $7,500. So you could actually even put in more than the 22,500 you could put in an additional $7,500 if you're over the age of 50. So that's important. So you may be wondering, well, what's the 2024 number? How much is the amount that I can put in 2024? 2023 is past. I missed that. Okay, well, in 2023, you can put in $23,000 into a traditional 401k plan and get a tax deduction. You can put up to that amount. Do you have to put in $23,000? No, you don't. You can put in $100 if you wish, but this is just showing you up to the limit and giving you that letting you know the size of these type of tax deductions that are available to you. Catch up contributions for people that are over the age of 50 and really trying to put money in these accounts. $7,500. So you could put an additional $7,500 into this account if you're over the age of 50. So that didn't change from last year, but the amount far as the for the employer plans, the 23,000 did. If you're like, hey, I don't work at these type of company that offers a 401k or a 403b or a 457, what kind of account can I put money in? You can put money into a traditional IRA account. And that IRA, think of that I as an individual retirement arrangement, an individual retirement account, whichever helps you remember that term. But that traditional part is the important part. That's where you could potentially get a deduction. But they put restrictions on the traditional IRA. So that's one of the things I want to keep people abreast of as well, as far as the tax deduction portion of this. You have to tax plan and strategize on your tax deductions because if you're single, there's an actual phase out between 77,000 and 87,000 that if you are putting money into a traditional IRA, if it's above that 77,000, you may not be able to get that full deduction. If it's over 87,000 that you have in earned income, then you're not going to have the ability to get a tax deduction from your IRA contribution. So yes, you can still contribute into your IRA. You can still get that tax deferred benefit from it, but you're not going to get the tax deduction benefit from it at that point. So if you're at that point, maybe you should consider looking at other options. But let me just give you, if what about if you're married? That threshold is a little bit bigger. It's 123,000 to 143,000. So it's a little bit bigger there. Something to for you to keep in mind. So yes, is there a lot of numbers here? Absolutely. Here's a real quick. I want to give you a few more items, and please go to my website, mountaintopwealth.com. Go to the blog session, check out the site, of course, but go to the blog session, go to the tax numbers. You can literally download a file for free where it has these numbers and some of this information so you can know it for the future. And if you want more tax planning, reach out to me and I will talk with you, help you plan things out going forward. If that's what type of help are you looking for? Do I file taxes? I do not file taxes, but I will help you plan for the future and help you better understand things. So when you go to your tax preparer, you'll be more prepared and able to save on your taxes in the future because you've put money in the right places.